Here is a question that millions of Canadians have never asked out loud, because it feels like something they should already know. What actually is a stock? Not the textbook definition, not the jargon. What is it, in plain English? And why does a number on a screen go up and down every single day in ways that seem completely random? Here's what's remarkable. The Canadian stock market, the Toronto Stock Exchange, had a total market capitalization of approximately $3.8 trillion as of early 2026. The S&P/TSX Composite Index tracks around 200 to 250 of Canada's largest companies. On June 1, 2026, the TSX sat at approximately 34,735 points, up over 31% compared to the same time the previous year. Millions of Canadians own a piece of those companies through their TFSAs, RRSPs, and pension funds, often without fully understanding what it means to own a stock, why the price changes, or what actually drives a share to be worth more or less on any given day. This video fixes that. No jargon, no assumptions, just a plain language explanation of what a stock is, how companies go public, how share prices are determined, why they move, and what every beginner needs to understand before putting a single dollar into any stock or ETF. By the end of this video, you will understand the stock market better than most Canadians who have been investing for years. Let's forget every financial definition you've ever heard. Here's the only explanation of a stock you actually need. Imagine you own a pizza restaurant. It's doing well. You want to expand, open 5 more locations, but you don't have the capital to do it alone. So you bring in partners. You divide the business into 1,000 equal pieces, called shares. You keep 600 of them. You sell the other 400 to investors who give you the capital you need to expand. Each investor who buys a share now owns a proportional piece of the business. If the business makes money, they make money proportionally. If the business grows and becomes more valuable, their share is worth more too. That's a stock. Ownership of a piece of a business. Nothing more, nothing less. Now scale that up to a publicly traded company. Shopify, Canada's largest technology company by market capitalization as of 2026, has approximately 1.27 billion shares outstanding. Each share represents a proportional ownership interest in the entire company. When you buy one Shopify share, you own approximately 0.000000079% of Shopify. That is a tiny fraction, but it is genuine ownership. You are entitled to a proportional share of anything distributed to shareholders, and you have a proportional claim on the company's assets. The total market capitalization of a company is simply the share price multiplied by the number of shares outstanding. Market cap equals share price times shares outstanding. If Shopify has 1.27 billion shares and each trades at $170, the market cap is approximately $215.9 billion. That number represents what the entire stock market collectively believes the company is worth right now, at this moment. And that right now is the key phrase. Because the market cap changes every second the market is open. Driven by the price people are willing to pay for each share. Why that price changes is what the rest of this video explains. The 2 types of companies you'll encounter. Private companies, not listed on any exchange. You can't buy their shares without being an invited investor. Most small businesses in Canada are private. Public companies, listed on a stock exchange like the TSX. Their shares can be bought and sold by anyone with a brokerage account. The process of going from private to public is called an IPO, initial public offering. the moment a company first sells shares to the public. Your action step. Look up the market cap of any company you're considering investing in. You can find it by searching the company name plus market cap. A large market cap means the company is well established and widely held. A small market cap means higher potential growth, but also higher risk. Most people think of the stock market as a dramatic place. Traders yelling, prices flashing, fortunes made and lost in seconds. The reality in 2026 is far more mechanical and far more accessible. The Toronto Stock Exchange is Canada's primary stock exchange, the marketplace where shares of Canada's largest public companies are listed and traded. It is operated by TMX Group. The TSX lists approximately 1,500 companies, ranging from Canada's biggest banks to mining companies, technology firms, utilities, and real estate trusts. The S&P/TSX Composite Index, the main version of the TSX Index, tracks around 200 to 250 of the largest companies in Canada. This is what people mean when they say, the TSX was up today, or the TSX fell today. They're referring to the average performance of those largest companies. The TSX Venture Exchange, the TSXV, lists smaller, earlier-stage companies. Higher potential return, substantially higher risk. How a trade actually happens. When you open your Wealthsimple or Questrade app and buy 10 shares of Royal Bank, you are not buying those shares directly from RBC. You are buying them from another investor who wants to sell. The exchange is the marketplace that connects buyers and sellers. Here's the mechanism. Bid price. The highest price a buyer is currently willing to pay for the stock. Ask price. The lowest price a seller is currently willing to accept. Bid-ask spread. The gap between the two. The closer to zero, the more liquid and easily traded the stock. Market order. You agree to buy at whatever the current ask price is. Execution is immediate. Limit order. You set the maximum price you're willing to pay. Execution only happens if the price reaches that level. For large, liquid Canadian stocks like RBC or TD, the bid-ask spread is typically 1 to 3 cents. For small, thinly traded stocks, it can be much wider, meaning you pay significantly more than the last traded price. The TSX trades Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Time, excluding Canadian statutory holidays. Pre-market and after-hours trading are available at some brokerages, but with wider spreads and less liquidity. The role of the market maker and electronic trading. In 2026, virtually all TSX trading is electronic. Algorithmic systems match buyers and sellers in milliseconds. Market makers, firms that commit to buying and selling a stock at publicly quoted prices, provide liquidity by ensuring there is always a buyer and seller available for major listed securities. Your action step: open your brokerage app and look at the bid-ask spread on a stock or ETF you own. For liquid ETFs, like VDY or XEQT, the spread should be 1 to 2 cents. If you see a wide spread on a thinly traded stock, use a limit order rather than a market order to avoid overpaying. Here's the question at the heart of everything. What actually determines what a stock is worth? The short answer: supply and demand. Excess demand drives prices up. Excess supply pushes them down. That's the mechanism. But what drives the supply and demand is where it gets genuinely interesting. Here are the 5 fundamental forces that determine share prices, and real 2025/2026 Canadian examples of each. Force 1. Company earnings and profitability. The most fundamental driver of a stock price over the long run is a company's earnings, how much profit it makes. More profit generally means higher stock price. Less profit generally means lower stock price. When a company reports earnings, typically quarterly, the market immediately reprices the stock based on whether results were better or worse than expected. Enbridge reported Q1 2026 adjusted EPS of $0.98, ahead of consensus estimates on both metrics. Strong earnings that beat expectations are a primary driver of price appreciation. Force 2. Future expectations. The price-to-earnings ratio. Stocks don't just reflect current earnings. They reflect what investors expect future earnings to be. This is captured in the price-to-earnings ratio, PE ratio, one of the most used metrics in stock valuation. PE ratio equals share price divided by earnings per share. A PE of 15 means investors are paying $15 for every $1 of annual earnings the company produces. The TSX trades at a PE of approximately 17 to 18 times in 2026, meaning markets are pricing in continued earnings growth. A high PE like 40 or 50 signals investors expect rapid future growth. A low PE can signal value or a business in decline. Force 3. Interest rates. This is the force most beginners don't see clearly, and it drives massive market moves. When interest rates rise, bond yields rise too, making bonds a more attractive alternative to stocks. Money flows from stocks to bonds. Stock prices fall. When interest rates fall, the opposite happens. The Bank of Canada cut its rate 9 times, from 5% to 2.25%. Between June 2024 and October 2025. Each cut made stocks more attractive relative to fixed income, supporting equity valuations throughout the cutting cycle. Force 4. Supply and demand at the individual stock level. Excess demand will drive prices up, and excess supply will push prices down. This applies to individual stocks just as much as to any other market. When a company is added to a major index, like the S&P/TSX composite, every index ETF must buy that stock, creating sudden demand. When a large institutional investor sells a significant position, supply spikes, pushing the price temporarily lower. Force 5. Market sentiment and external events. On June 1, 2026, the TSX fell 0.10%, driven by geopolitical uncertainty, oil price movements, and rising bond yields pressuring financial stocks. RBC lost 1.3%, TD dropped 2.8%, while Shopify jumped 4.4%, tracking an AI-driven tech rally on Wall Street following NVIDIA's processor announcement. None of those moves were directly caused by changes in the underlying business's fundamental value. They were caused by news, sentiment, and the market's collective emotional reaction to external events. Your action step. The next time you see a stock price move, ask yourself which of these 5 forces drove it. News-driven moves are often temporary. Earnings-driven moves are often more durable. Understanding the cause helps you avoid panic selling on sentiment swings. Here's the open loop from the hook. The company posts record profits. The stock falls. The company misses its forecast. The stock rises. How? The answer is one of the most important concepts in investing. And it is something most financial textbooks bury in jargon when it is actually a very simple human truth. The stock market does not price what is happening. It prices what people expect will happen. More precisely, stocks are priced based on the gap between what people expected and what actually occurred. When a company posts record profits, if those profits were already anticipated and priced into the stock, there is no positive surprise. The market already reflected that expectation. If anything, the buy the rumor, sell the news pattern means some investors who bought on the expectation now sell on the reality. The price falls. When a company misses its forecast, if the miss is smaller than feared, the news is actually better than the worst-case scenario the market had priced in. Relief buying pushes the price up. This is called priced in, and understanding it separates people who understand markets from people who are always confused by them. Here's a real-world illustration from June 1st, 2026. TD Bank's share price dropped 2.8%, despite no specific announcement about TD's underlying business performance. The move was driven by rising bond yields and geopolitical uncertainty affecting the entire financial sector. The fundamentals of TD Bank didn't change in a single afternoon. The market's assessment of what future earnings are worth, discounted against rising yields, changed. The efficient market hypothesis simplified. Economists debate how efficiently markets price in all available information. The practical takeaway for individual investors is this: trying to consistently outsmart the collective market, buying stocks you think are underpriced before other investors realize it, is extraordinarily difficult even for professional fund managers. More than 80% of actively managed Canadian funds underperform their benchmark index over 10 years after fees. This is the central argument for index investing. Not that the market is perfectly rational. It clearly isn't, as the June 1st examples show, but that the market is efficient enough that trying to beat it consistently is not a winning strategy for most investors. The two types of price moves worth distinguishing: fundamental moves, driven by actual changes in earnings, dividends, business outlook. These tend to be more durable. When Enbridge raises its dividend for the 31st consecutive year, that's a fundamental signal of business strength. Sentiment moves, driven by fear, greed, news, and market psychology. These tend to be more temporary. The broad market falling because of geopolitical uncertainty typically reverses as the uncertainty resolves. Your action step: the next time a stock you own drops in price, ask, did the fundamental business change? Or did sentiment change? If the business is unchanged, the lower price is not a reason to sell. It may be a reason to buy more. Here's where everything this video has explained connects to what you should actually do with your TFSA. You now understand what a stock is. You understand how exchanges work. You understand the 5 forces behind price movements. You understand why prices sometimes move in seemingly irrational ways. Now here's the honest practical question: should you be picking individual stocks? For most Canadian beginners, the answer is no, and the data explains exactly why. The case for ETFs over individual stocks for beginners. When you buy an individual stock, you own one company. Your return depends entirely on how that one company performs. If RBC has a great year, you win. If RBC has a poor year, you lose. Your outcome is concentrated on a single business. When you buy an ETF like XEQT, you own approximately 9,000 companies simultaneously. No single company's failure can materially harm your portfolio. The Canadian stock market, the American stock market, and international markets all fail catastrophically. Simultaneously would be required to destroy your wealth, an event unprecedented in the history of markets. The S&P/TSX composite has returned approximately 7% to 10% annually over long periods, and Canadian and global stock markets have returned roughly 7 to 10% per year on average historically. That return is available to any Canadian who simply buys an index ETF and holds it without research, without earnings calls, without balance sheet analysis. When individual stocks make sense, You have a genuine informational advantage about a specific company or sector. You have time to research annual reports, understand competitive dynamics, and monitor ongoing developments. You understand and accept that individual stocks carry substantially higher risk than diversified ETFs. Individual stock positions represent a small allocation on top of a core diversified ETF base, not the entire portfolio. For most Canadians, especially beginners, the optimal approach is a diversified all-in-one ETF as the core portfolio, with individual stocks only as a satellite allocation once the foundation is established. The key numbers that make this concrete. A Canadian who invested $10,000 in the S&P/TSX composite in 2010 and held it through 2025 would have seen significant growth through market cycles. The TSX was up approximately 31.63% year over year as of June 1, 2026, meaning the patient, long-term holder was rewarded not by picking the right stocks, but by staying invested through every downturn. Your action step. Before buying any individual stock, ask yourself, do I understand this business well enough to explain in one paragraph why it will be worth more in 10 years than it is today? If the answer is no, an ETF is the better choice. What actually is a stock? A stock is ownership of a piece of a real business. When a company needs capital to grow, it divides itself into shares and sells them to investors. Each investor who buys a share owns a proportional piece of everything that company is worth. The share price at any given moment is what the collective market, millions of buyers and sellers, agrees that proportional piece is currently worth. That price changes based on 5 forces: earnings, future expectations, interest rates, supply and demand, and market sentiment. Sometimes prices move in ways that seem irrational, because markets price expectations, not reality. The gap between what was expected and what occurred is what actually moves the price. The TSX, Canada's main stock exchange, trades approximately 1,500 companies and is tracked by the S&P/TSX Composite Index, covering 200 to 250 of the largest. As of June 1, 2026, the TSX sits at 34,735 points, up over 31% year over year. The patient, long-term investor who held through every dip in that period captured those returns. For most Canadian beginners, you don't need to understand every detail of how individual stocks are valued to invest effectively. You need a TFSA, an all-in-one index ETF, an automatic monthly contribution, and the discipline to hold through volatility without selling. The stock market can seem complicated. The strategy for profiting from it over the long run is simple. Understand what you own. Buy it consistently. Hold it permanently. Let compound interest do the rest.